Welcome back. It's time for your business update. Singapore's largest lender, DBS Bank, says that the country's currency could match the US greenback in the next 15 years. Its report also says by 2040, Singapore's economy could more than double. We break down the projections. Now, analysts say for the Singapore dollar to strengthen further, the country's labour productivity needs to outpace the US. And that's not all. It needs to attract strong investment inflows and a sustained current account surplus. A continued weakening of the US dollar would also work in Singapore's favour. Now, DBS says the Straits Times Index, or STI, could rise to nearly 10,000 by 2040. And this year, the benchmark broke a 17-year ceiling, crossing 4,000. It signalled a medium-term bullish shift. To reach the new milestone, it could be driven by global fund inflows. And on top of that, a low domestic interest rate environment and support measures from the central bank would give some support. Now, the measures include the 5 billion Sing dollar equity market development program. DBS says the country's real gross domestic product, or GDP, is growing, and it could increase at an average of 2.3% yearly until 2040. That means Singapore's economy could more than double to reach between $1.55 trillion and $1.81 trillion. That's up from about $710 billion last year. This growth could be driven by more investment, better skilled workers, and higher productivity. Services may give the biggest boost as Singapore deepens its role as a global hub. The report also highlighted several growth areas. These are trade, financial services, energy, and climate. The expansion of land-sea infrastructure will also support the momentum. Expansion of the real estate sector with new homes and strong property prices will also provide some lift. Demand for healthcare and senior services could rise as the population ages. Unveiling the report, DBS CEO Tan Su Shan urged companies to keep pace with rapid tech changes. She also called on firms to diversify the supply chain, both upstream and on the demand side. Ms. Tan encouraged companies to be bold and to stay competitive.
So as we defend what we have, we really have something going. Everyone loves being here. It's an easy place to do work, to live, to do business. But can we disrupt the comfort we're in? Are we willing to take one step back to take two steps forward?
An economist says these projections are a best-case scenario. The upbeat outlook depends on some key sectors like trade and connectivity. Singapore's ability to overcome obstacles will also be a factor, but it also comes with assumptions and how risks are mitigated.
If you look at, say, risk, geopolitical risk, if the situation deteriorates, it will not be possible for Singapore to thrive, even in some of the key sectors. If the macroeconomic environment, trade, or even the wild card, maybe inflation, will come, Singapore will be caught in between, because if there's inflation, the policy response might be to raise the interest rate, and this will have a downward push on economic growth.
Speaking at the launch of the report, Singapore's Central Bank Deputy Chairman Chee Hong Tat outlined plans to boost the capital markets. There are also plans to strengthen Singapore's position as an international financial centre. This includes help for listed companies to create more value and prepare workers and firms to use AI. He also says that the financial services sector remains a cornerstone of the nation's economy. Last year, the industry made up about 14% of Singapore's GDP and grew by 6.8% on year. That's more than twice the rate of the previous year. The National Development Minister also noted that growth was broad-based. Segments like banking, insurance, capital markets, and asset and wealth management helped propel the expansion. Mr. Chee says more details to help strengthen capital markets will be announced next month. And looking ahead, he says Singapore will build capabilities and resilience, strengthen trade, payment, and financial links. There are also plans to groom a pipeline of industry talent.
We will continue to invest in growing and upskilling our local workforce, ensuring that they are equipped with the skills and knowledge needed to thrive in a new environment. At the same time, we must remain open to attracting and integrating global talent that can complement our local workforce so that we can further strengthen the overall competitiveness of our financial services industry.
And to delve deeper into the report, we have in studio tonight Taimur Baig, who is the Chief Economist of DBS Bank. Taimur, welcome to the show.
Great to be here.
Well, first of all, this report is very optimistic. Can you tell us about where the confidence is coming from?
It's optimistic, not very optimistic. If it was very optimistic, we'll be focusing on making projections like 3.5% growth every year for the next 15 years on the back of massive capital inflow and massive pickup on productivity thanks to AI. We're not doing any of that. So I would say this is more of a central optimistic scenario. Things can always go wrong. We know lots of things from trade war to tech disruption to aging that can hold growth back. But we feel, going through this fairly painstaking process of writing this report, 20 analysts, 125-page report, we feel that we have looked at these challenges and we have seen gestation of solutions already in place. So that's the key issue, that when we look at GDP doubling over the next 15 years, Sing dollar appreciating significantly against the US dollar, these are based on trends and ingredients for them are already in place. We're not making them up from thin air.
So let's look more deeply into the research then. The report forecasts that Singapore's real GDP growth will average about 2.3% annually. That's from 2025 to 2040. It's going to outpace advanced economies. There's also a projection that over 15 years, which is quite a long time, what do you think are the critical drivers for sustainable growth at this time, and also the possible risks?
One word: productivity. There is a decent quantity of high-skilled laborers in this country. There's a lot of capital in this country. What we need is the labor and the capital to come together with the help of technology and good policymaking and boost productivity, efficiency. This has been a bugbear of Singapore in the past decade and a half. We need to take productivity growth from very anemic levels to standard, decent levels. Even if total factor productivity were to grow by 0% over the next 15 years, labor and capital accumulation would take care of 2.5% growth, not a problem.
Well, let's look at another interesting finding in the report. It's predicting that the Singapore dollar could reach parity with the US dollar by 2040. What would you say is the reason behind this projection? What is the impact of this?
Singapore runs a large current account surplus. The rest of the world find it worth their while to invest in Singapore. Sustained flows, both at the FDI level and the portfolio level, would continue in our view. Singapore is also outpacing most industrial economies in terms of productivity growth. That will continue as well. And finally, I think the most important part is that there is this general tendency among global investors to look to diversify their asset portfolio positioning. And US dollar, everybody's overexposed. They need a couple of countries out there with high rating, good fundamentals, stable rule of law. Singapore shines in those areas, and that's what would drive the medium-term appreciation of the exchange rate.
And another interesting part of this report is that the STI is projected to reach 10,000 by 2040. What kind of specific reforms or market conditions do you think would be essential to meeting this target?
Okay. First of all, again, rather conservative projection. We're not doing a pie-in-the-sky projection. Very moderate mid-level earnings growth, dividend ability, decent performance by companies would propel Singapore STI to go toward 10,000 in 15 years' time in our view. It would be nice to have the authorities paving the way for more financial sector liberalization, placing some capital so the fund managers find it worth their while to invest. Things are already happening under the equity development program. So we think that some nudge from the public sector, some degree of vitality in the local ecosystem of entrepreneurs coming up with interesting companies, interesting ideas that can scale, not just in Singapore, but globally. And then those companies get listed here. The moment dynamic like that gets unleashed, the rest of the world would be happy to put their capital in Singapore stocks.
Yeah, and Taimur, Singapore has also aimed to achieve net zero emissions by 2050. What are some potential challenges you foresee might get in the way when it comes to securing long-term agreements with neighboring countries, for example, especially for renewable imports?
I just got back from the United States. Their ESG is a word that you don't want to use anymore. There's a huge amount of pushback at the federal government level against environmental and sustainability issues. That is not the case in the rest of the world. When we look at China, when we look at Europe, when we look at Southeast Asia, move towards zero net emission continues unabated. Singapore needs cleaner energy. Cooperation with the rest of the region is important. The region needs some degree of leadership on the technology side, on the capital formation side. Whether it is carbon trading or green bonds, I think Singapore is the right place for the capital market activity around green transition to take place. That itself would then fund and facilitate Singapore's own green transition.
Yeah, and speaking of that transition to green energy, Singapore sees hydrogen as a key pillar of that path forward, as you would see it. But given the high costs and also, the technological uncertainties, how realistic are these timelines and also the targets for its implementation?
It's expensive. It's a long, arduous path. There could be setbacks, but we have solar. We have wind. We have biomass-related energy solutions coming up. We have small nuclear reactors coming back into vogue. So the menu of options toward a zero or very low emission economy is pretty wide. Hydrogen is a key, potentially consequential element. It's not the only thing. Singapore has a few other cards up its sleeve. So it will not be held back if there's a setback around the hydrogen side.
Yeah, diversification here
Absolutely.
would be quite key. Let's shift gears now to talk about healthcare spending. So the report also projects that government healthcare spending will reach 30 billion Sing dollars by 2030, especially driven by that aging population. So how does this report address the sustainability of this healthcare financing in the face of these rising costs and uncertainties?
The rising cost is a given. I don't think there is much uncertainty. We know the nation will continue aging, and therefore huge amount of solutions would need to be available in elder care, in logistics for the elderly, and the whole suite of drug discovery, new patient-related services all need to be put in place. So I think that as Singapore ages, just like the way Japan has aged, just like the way China has aged, we have to find business opportunities to take care of this aging population, keep them more productive, make them a vital part of the economy, and I think that's where the opportunities and the value addition comes in. We are not looking at the silverification of Singapore as a threat. We're looking at it as an opportunity.
Taimur, thank you so much for sharing your insights with us today.